Good afternoon and welcome to the Distribution Finance Capital Holdings PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to CEO Carl Damassa. Good afternoon to you.
Thanks very much, Alex. Welcome everyone to our interim results. Just introducing myself again for anybody that hasn't been here before. I'm Carl Damassa. I'm the CEO of DF Capital, and Gary Morris, our CFO, will be presenting with me today. Before we launch into the full year, the half year results, I thought it might be just worth for anybody that needs a reminder of what we do and what we're about. Just a couple of minutes overview on the firm. We were founded in 2016 as a non-bank lender, providing working capital solutions to dealers and manufacturers, predominantly based in the UK. And we pursued a banking license and were authorised 4 years ago, actually, into coming out of COVID in September 2020. And we've stayed true to the principles and the segments that we were founded to support, i.e., those manufacturers and those dealers. That being said, we have scaled the bank, since authorisation. Over the last 4 years, and we support an array of dealers and manufacturers across a significant number of sectors now: motorhomes, caravans, lodges, holiday homes, commercial vehicles, plant and machinery, industrial equipment, motorcycles, marine. The automotive now as well is in our armoury. So we are a very diverse lender. We do lend against individual assets that allow manufacturers to ship products to a dealer's forecourt so that they have product to display that are available to purchase by their end users. We take individual title of those assets, and we are repaid in full once the dealer sells the asset. And what we hope happens then is that that vacant plot on the forecourt is filled with another motorhome or caravan or boat or commercial vehicle. Our lending is short in tenor. It's typically about 150 days. And you'll hear a little bit later on that whilst we are a floor plan or inventory finance or stock finance provider, we do have ambitions to support our dealers and our manufacturer partners in a significant way, unlocking other routes to sell their products. But I'll talk about that a little bit later on. This is I'm fondly calling this my happy slide, because we've had a amazing start to the year. Once we received authorisation in September 2020, we became almost myopic in looking to get to break even and through profitability, and we were break even very shortly after authorisation. So it's great for us to be reporting now that almost at that 4-year milestone that we now are at a significant and sustainable profitable run rate. For the first half of this year, we achieved a profit before tax of 9.2 million, which is 180% up on the same period last year, and double the full year outturn of 4.6 million in 2023. That 9.2 did include a 1.7 million recovery in relation to an impaired loan that we took last year. But even if you remove that 1.7 million, to have an underlying 7.5 million's worth of worth of profit before tax is really pleasing to see. In relation to that impaired loan, we are looking to also see a potential upside next year in relation to an additional £3 million worth of recovery, but that hasn't been captured in this year's accounts anywhere. We'd expect that to roll through next year. What's been really pleasing, and I guess is the route of the route to profitability, has been the scaling of the bank and the growth in our new lending. We're now at a record £710 million worth of lending in the first half of the year, which is up 17% on the same period in 2023, and the loan book reached over 600 million as well, which is up 16%. Additionally, our net interest margin, which is our gross revenue, in simple terms, minus our cost of funding, which we raise via deposits, has been strong at 7.8%, and that's really been off the back of Bank of England base rate changes, efficiency in how we raise our retail deposits, and continued, I guess, pricing discipline, and how we allocate our capital across the firm. It's always easy as a lender to push money out to borrowers, and we've been very focused on credit quality and ensuring that we bring on high quality to dealers, and that across our 1,200 or so dealers, we do see a continued improvement in the overall quality, and that will be no surprise that our level of arrears is very low. We've got about 0.5%, so 0.5% of the loan book, which is 1 day past due. I think those of you that are used to financial stocks will know that most lenders report arrears 1 month down. We report it 1 day past due, and our arrears numbers also include those accounts that are in legal workout as well. If we adjust for the recovery in relation to into Royal Life, which we wrote off last year, our cost of risk, which is provisions and impairments, remains very low, well below our 1% through the cycle at 0.61. As we've scaled the firm as well, we've continued to see cost efficiency. So our cost to income ratio has improved by almost 3 points, and that's despite ongoing inflationary pressures, whether that's wage inflation or suppliers pushing through rate increases, and that's largely because our platform is highly digital. We have latent capacity in our operating model, and we've continued to invest in technology solutions that will make us more efficient. It's also worth pointing out as well that that cost efficiency also includes investments in some of the new products and services that we'll talk about a little bit later on. Really pleased to also report the return on equity tipping over 10%, and that's adjusted for that one-off recovery, and that's the first time that we've tipped over 10% ROE. But you can see that we're now really building momentum towards the mid to high teens returns target that we've talked to you and the wider investor community about. And I guess what's also really pleasing is that the retained earnings is enable us to self-generate capital that supports growth. So our tangible net assets have increased by 9 million year on year, which pushes our tangible net assets to 107 million and the tangible net asset per share to almost 60 pence. Just comparing, the half years with the half years. I won't go through all of these numbers, but you can see, the growth in loan book, the growth in gross yield, the stable, position in relation to the net interest margin, and the growth in shareholder value as far as tangible net asset value is concerned. It's also worth noting just in relation to the cost of risk, that whilst that is slowly tipping up over the years, it is very much below that 1% through the cycle, and is also much lower than where we were in 2020 when we were at 86 bips, as a percentage of the overall portfolio. So you can see why I've sort of described the first slide, and I guess this one as the happy slide, given the extent of performance across the group. Just looking at in a little bit more detail about originations, there's no doubt to us that our products and services continue to resonate with dealers. We're supporting more dealers than ever before. We have more credit lines pledged to dealers than ever before, whilst also being very choosy who we choose to operate with. And that has seen quarter on quarter over an extended period of time, that our new loan origination has grown significantly, and we have a CAGR of almost 40% in relation to that loan book growth. I think it's fair to say, for those of you that have been tuned into the story for quite a while, that since the pandemic, there has been a fair amount of volatility in supply chains that has meant at some point for dealers, it's been bonanza seasons with strong sales, because they've struggled to get stock. There's been scarcity in stock, and elements of the supply chain have really struggled. We're now starting to come into a period that we believe is actually more a normalization, i.e., more like the pre-pandemic period. So as I mentioned when I introduced the business, we are seeing our stock days extend, which is good news for our lending balance, but it actually is not an extreme that we need to be worried. It is more at normalized levels, which is about 150 days. And we do, by sector, keep an eye on this, and actually by dealer as well, and take any action that we need to. I just wanted to talk about some of the extremities that we're seeing across the sectors that we operate, and we have seen in the motorhome and caravan markets that there has been very strong loan origination, which means lots of stock hitting the dealer's forecourt. But we've also seen quite significant sales, despite the cost of living crisis, despite the higher interest rates. Motorhomes and caravans have been in very strong demand and continue to be. Conversely, at the other extreme, the lodges, the holiday home space, these are all prefabricated, I should say, holiday homes and residential units. That has perhaps struggled more significantly on a relative basis. Dealers have adequate stock. There's been minimal new products being taken onto the forecourts, and some actually of the holiday parks have been converting stock for sale to rental units, which we've been happy to support. It seems a sensible thing to do. So stock days has extended in that lodge space out to 288 days. Seems to have stabilized there, but that's well within our appetite of 300 days. And as I say, if we are worried about particular dealers, we do take early action as well. So I just wanted to talk through those extremities as far as the markets are concerned. What I'll do now is I'll hand over to Gavin just to talk through the financial statements and performance of the group in a bit more detail. So over to you, Gavin.
Great, thank you, Carl. So I'll drill down more into the income statement and the balance sheet. So if we start off with the income statement, this clearly shows the strong underlying sustainable profit we're generating. Starting off at net income, we've seen a 24% growth in net income. That's a function of both loan book growth and the very strong net interest margin of 7.8%. The driver of that high net interest margin, one, we've got strong pricing discipline and we've been able to pass on base rate movements to our dealer customers as base rates have gone up. The loan book matures more quickly, it's about 150 days than our deposit book, and therefore although deposit rates have also gone up as base rates have gone up, they've gone up more slowly, and therefore we've benefited from that. Additionally, deposit rates haven't gone up to the same extent as base rates. That's given us further upside. We're now in a sort of rates downward cycle, and therefore you would expect some of that to reverse as we go through that, but we would expect NIM to reduce over the medium term. We don't expect it to reduce very quickly at this stage. If I move on to staff costs, I think it's key to highlight that at the moment in the business, we've got the people resource we require over the near term to scale our existing lending in our existing products and our retail deposit propositions. We've got what we need in the business now to do that, so we don't really need to be adding on many more heads to do that. Therefore, that allows us to unlock further operational leverage as we grow the loan book. This is reflected in we've had a 9% increase in staff costs, which obviously includes general wage inflation, and that compares against the 24% increase we've seen in our net income. In respect of other operating expenses, this increase reflects us continuing to invest in IT, and this is both in ongoing automation, which will give us efficiencies going forwards, but also in our IT infrastructure as we grow and mature as a bank. It also reflects the investment we've made in our HP product that we will continue to invest in back end of this year through into the start of next year. Therefore, despite the inflationary pressures, we've further reduced our cost income ratio, as Carl highlighted at the start, from 61.5% to 58.8%. In respect of impairment charges, Carl's really covered this. The underlying cost of risk is 1.8 million, which is running at 61 bips, and although it has gone up on the prior half year, it's still a very low number that we're very happy with. So what that gives you is an adjusted profit before tax of 7.5 million, and that's a 25% increase compared to prior year. And as Carl said, we just I guess highlight the fact that it's now a double-digit post-tax return on equity, and that's at 10.3%. If you then add in the right back we've got on the Royal Life case, that's a 9.2 million profit before tax for the first half, which again we're delighted with. If I move to the balance sheet, we've touched on the growth in the loan book, up 16% to just over 600 million. Our deposits have grown accordingly, and they're now at 579 million. That's across about 15,000 different depository accounts. And I just thought I'd spend a bit of time highlighting our deposit proposition, because we are delighted with the performance of it to date. We have a strong retention rate, so when our products mature, we have about a 60% retention rate. Earlier this year, we received FIFO's Platinum Trusted Service Award. Our FIFO scores have increased during the period from 4.7 out of 5 to 4.8 out of 5, which shows the great customer satisfaction we're getting. And we've recently launched our first business savings account. So our expectation is on business savings, we can get raise deposits at a slightly lower rate than the retail deposit accounts, probably in the region of 30 to 60 basis points. But it is a smaller market. So the growth in the business deposits is going to build over time. It's not going to be sudden. But that just, again, gives us further product diversification as we grow the loan book and therefore raise deposits accordingly. In respect of our risk-weighted assets, you can see that these have increased significantly less than the loan book increase. And this is a reflection of the capital efficiency we're getting from our BBB Enable Guarantee Scheme. As a reminder, we further upsized that scheme from 250 million to 350 million in July. So that's now, we're using that to its full capacity. Our capital position therefore means we're well positioned for future growth ambitions. At this stage, given our current capital, the BBB Enable Guarantee Scheme and our Tier 2 funding, which we've currently drawn 10 million and there's a further 10 million to go, we can grow the loan book to around 850 million, slightly higher. But the expectation is at that point, we're generating sufficient profitability to reinvest that in the business to grow the loan book at another 100 million or so a year. And then just to bring out again, what we've seen is our tangible net asset value has increased by over 4p over the last 6 months. So that's now almost 60p. Moving on to our credit performance. At this stage, we're not seeing any signs of a weakening customer position, but as Carl said, we are myopic, not just on profitability, but on keeping our arrears down. So we're myopic and looking at this in the portfolio. And our strong portfolio management and focus has meant at June, there were just 19 dealers out of our total dealer base of 1,250. There were 19 dealers 1 day in arrears. And that translates to just about 0.5% of the loan book. And that has translated to cost of risk in the first half of 0.6%. Again, it's well below our through the cycle appetite of 1%. Moving on to the next slide. This shows the diversification and the strong asset security across our portfolio. And we split that into sort of the 3 main segments in the way we look at the portfolio. As a reminder, we advance our funds against wholesale value, not retail value. And on average, there's around a 20% retail markup. So where we talk here about, we've got an LTV against wholesale of about 83%. Against retail, that would be more like 70%. The reduction in LTV we've seen over the period, that's a function of, because we're seeing our stock days extend back to what we see as the more historical norm of 150 days from circa 120 days. That's an extra month that's on our books. And as a reminder, our dealers are paying principal repayments every month. So that means additional principal repayments, which brings down the loan to value. If we look at the trends we're seeing in these sectors, I think Carl's touched on the leisure sector with some issues we've seen with lodges. High interest rate environment has driven reduced demand. Counter to that, we've seen some very strong both originations and sales in respect of motorhome and caravan. And motorhome and caravan is now our largest sector at 163 million. Moving on to power sports. In marine, we've seen strong demand at the luxury end of the market and therefore a slight shortening of stock days. And we've onboarded new customers in this area and increasing utilisation, which is helping us grow the loan book. The launch of our specialist automotive is progressing well, and you can see it's grown substantially in H1 from a relatively low base. It's almost tripled in size to 22 million at the half year. In respect of the commercial segment, the general economic uncertainties muted demand in industrial and agriculture, so we've seen those stay fairly flat. And in transport, and when we talk about transport, we're talking sort of like commercial vehicles. We're not talking cars here. Demand has been muted. We've seen product discounting across manufacturers. Dealers are carefully managing the inventory and how much they want on their forecourt, but we expect this to improve as we head into 2025. So Carl, can I hand back to you on the outlook?
Thanks, Gavin. So, well, I think one of the things that I think you can see is that we've been building a very strong capability, but have been talking for an extended period of time about how are we going to get to the mid to high teens return on equity, and that comes through further scaling the bank and becoming a multi-product lender, supporting those the dealers and the manufacturer partners. And we have on our journey, as for those of you that have been following us for an extended period of time, looked at how we could enhance our product suite, develop our product suite further by looking at M&A opportunities, acquiring capabilities, and if I'm honest, we haven't found the right fit. We are quite a cautious firm in how we want to bring things onto it for our customers, and we want to make sure that any acquisition was going to be successful, and had the right characteristics, financial characteristics and performance characteristics. So we decided at the back end of last year that actually developing products and services organically was the right route forward. And as I mentioned earlier, we have been investing through this year, and we've been investing on two fronts. To look at new sectors that we can transact in from an inventory finance perspective. So we've built a technology-based product capability. It's very early stage in its rollout at the moment, that will allow us to support serialized assets in warehouse and alike, with sophisticated integration with stock management systems of distributors, whilst we still maintain the level of returns and security in the underlying assets. So we think that will work really well in technology-based and things like renewables, the renewables markets. And we've already got a relationship in that regard. So that universe, that market, is quite sizable. So we can be quite choosy about where we look to play. I think the biggest play and probably the most in demand for us is sales aid financing. So I think you'll recognise that when a motorhome, a caravan, or a light commercial vehicle or piece of plant and machinery leaves a forecourt, generally it's financed by a bank in some guise. So we built HP asset finance capability. We're expecting that to be system ready by the end of this year, and then we look to start lending to the end users of the product in the early part of 2025, certainly in the first half. And that is significant markets for us to operate in. And as I say, it can't come quick enough for a number of our larger dealer partners. So I think one of the questions, we'll come to the question shortly, but we've really worked hard to continue to scale the bank and use capital efficient tools to support that growth. So we've worked with the British Business Bank on the Enable Guarantee. Enable Guarantee has extended to 350 million. We've also raised tier 2 capital to sit alongside the tier 1 capital. So 10 million utilised, a further 10 million available for us to draw on from British Business Investments. And that aggregate position allows us to get from that 600 million that we reported to about 850 million, which we think will probably be by the end of next year. Getting to 850 million, we don't need tier 1 capital to do that, but it does give us optionality then, because we are throwing off adequate retained earnings to consider what we do with those retained earnings, and we could plough all of that into support further organic growth without Tier 1 capital, growing at roughly 100 million a year across the array of lending products that we're looking to develop. We're really pleased with where we're at the half year. Performance is strong as we look forward now, towards the end of the year. We're expecting our loan book to land at the end of the year in a 650 to 700 million range, which is in line with the current expectations of the board for the full year performance, which clearly will be significantly up on prior years, and will continue to deliver that double-digit ROE that you've seen in the first half. So I think what we could do now is, thanks very much, because we've had quite a few questions. So what I'll try to do is perhaps bring some of these together.
That's great, Carl. Gavin, thank you very much indeed. If I may just jump back in there. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Carl, Gavin, as you mentioned, we have received a number of questions throughout today's presentation. And if I may now hand back to you and kindly ask you to read out the questions, give responses where appropriate to do so, and I'll pick up from you both at the end. Thank you.
Okay, thanks very much, Alex. So we won't address it. As I say, I'll try and cluster these together by common themes. So let me deal with we've got a couple of questions in relation to Royal Life and general recoveries. So I think we perhaps covered this last time. What have been the lessons learned? I mean, Royal Life was in itself unique in our portfolio from an ownership structure, from a size and from a shape perspective. We've learned an awful lot, from that, in how we manage those. That being said, but we've also, determined, having learnt the lessons without going through all of the detail, we have made some, sizable adjustments to our credit risk appetite in relation to groups of, similar complexity and similar ownership structures. That makes the movement of cash across the group entities very difficult to track and monitor. So I'm confident on an existing portfolio basis and a go forward basis that we won't have anything that has the characteristics of Royal Life. I think one of the other questions then really is, what's your record in making recovery? And I think one of the things that because we've got such a good story on losses, it doesn't actually present what actually goes on in the business intra-period. The individual asked the question, Saeed. Yes, we are asset backed. We have full security, and we do quickly run in, repossess assets, use our relationships across the sectors to redistribute those assets. Often we call on the manufacturer because we have repurchase arrangements in place, and in some cases, our loan to value is quite low. So on a net basis, we actually will find that we can actually maybe make some money, and considerably clear our position. So the cleanness of our portfolio and the output metrics that you see really doesn't demonstrate the amount of work and the strength of security that we have in place across our lending products. There've been a few questions around deposit raising, I think. So you recently launched a business savings account. Can you explain the strategic value of diversifying your deposit base and how you plan to scale this new product? And then next question is, can you explain your customer deposit strategy? I notice at the moment your deposit offering are shorter dated term deposits. How do customers tend to learn about the bank? And then the final question on deposits is, what percentage of your total deposit funding falls under the FSCS guarantee? So I think, Gavin, you could probably answer all that in one go, I would have thought.
Yeah, absolutely. So if I start off with our strategy in general, so effectively the way we raise deposits is we have something which we call a great rate strategy. So at the point, so obviously we're forecasting, we're understanding the growth in our loan book, the maturity of existing deposits, so we can clearly see what deposits we need to raise. And the way we raise deposits, it's very simple. We will go at the top or in the top 3 of the best buy tables, and the money comes in very quickly. The level depends on which market you go into. So for example, about a year ago, we went into easy access and we went top of the table. And I think within about a day, or we pulled the product after 36 hours, and we'd had 50 million of applications. And you normally get about 80% of that ended up turning into cash coming in the door over the next 10 days. So it's really being top of the best buy table. And I think we've now got brand recognition, and you've got the very strong FIFO scores that have come through, which helps sort of strengthen that. In terms of deciding, there's a question about at the moment our deposits are shorter term dated deposits. When we're looking to raise deposits, we're looking at the maturity profile of our asset repayments, the maturity profile of our deposits, and also the pricing in the market. And we're weighing that all up to decide what's the most appropriate. But we have to carefully manage our deposit maturity profile to make sure we've got no repayment cliffs. If we then move on to sort of further diversification on business savings, so as we just said, business savings has gone live in the last couple of months. The strategy there is very similar, that we would look to be top of the best buy tables, but it's fair to say that if you're top of the best buy tables, the money comes in far more slowly than retail. So we see this as an opportunity to get some cheaper funding in. There is a little bit more work to do up front to bring that depositor on your books because of the sort of onboarding we have to do. And therefore we see that as being slow, steady growth to help diversify our deposit product portfolio going forward, but it's not going to happen overnight. That will take some time. And then finally on FSCS, the vast majority of our customers hold less than the 85,000. I think the number's around 98% is FSCS, but it's certainly north of 95%.
Great. I suppose the root of the question may also be, you don't seem to be in the market very often. We've worked really hard to retain our retail deposit customers. So we do have a number of loyalty products, as we would call them, that are happening behind the scenes. And anybody that happens to be on this call and is a depositor as well, you've probably seen us offering loyalty products that aren't there in the open market. It's far better for us to retain an existing customer. Gavin, I think on the business savings side of things, there was you had an example of the rate differential between retail and business.
So today we've got 2 products out there. We've got two 90-day notice products. One's retail, and that's top of the market paying 5.3%, and one's business, and that's top of the market paying 4.76%. So that's a 54 basis point differential for effectively the same product if you compare business to retail.
I think we'd love the market to be huge for business, but in reality it's not. So we've got to have a whole nice mix of all this to bring the funding cost down. One of the questions then is around hire purchase and what's your targets. I mean, look, the opportunity is huge, but as I said, we are very conservative in launching new things. We're probably in the early stages of anything very cautious about our growth ambitions. Where I would see this unfolding is, it could be quite a significant play for us. But what we do need to just keep an eye on is returns, and particularly if we do find that we're not wanting to raise further capital next year. What I want to be doing is putting the capital to work at the highest returning lending channels. So I don't want to be vague in saying what the targets are, but they're sensible. The opportunity is huge, but regardless, any product that we're in, it will be the strongest risk-adjusted return that we'll be looking to deliver on that.
Sorry, just on HP, I think it's just worth stressing. So, I guess one of the beauties of the HP product is, at the moment, our inventory finance product, as we said, it turns in about 150 days. So last year, about 1.3 million origination, and the loan book was about 600 million. If we convert a small portion of those assets when they're sold off the forecourt into HP, that HP product is going to sit on our balance sheet for sort of 4, 5, 6, 7 years. So that's the great thing about HP. It just gives us far longer maturity of assets once they're on our book.
Yeah. And the capital characteristics of lending are different. Clearly a HP proposition would be more diversified for us as well. So there's a whole array of things that you clearly would be expecting us to take a look at as we look to push on with growth. As far as loan to values are concerned, we'd be expecting against new units, which should obviously be the dominance of our lending, to be taking what is customary, a 10% deposit up front, and then that clearly the product is fully amortizing from there. On used assets, clearly there's a much bigger deposit required in relation to that lending, although our starting point would always be against new. Just looking at some of the questions around capital. One of the questions is around an equity raise. When might you expect to fully utilize loan facility, and will an equity raise be necessary soon to fund further growth? Well, we've got enough runway to get to 850 million. The firm does not need to raise capital. However, the opportunities that are ahead of us are quite significant, and we could decide, if we wanted to accelerate our growth journey, to do a tier 1 placing. If we did not do a tier 1 placing, then as I said earlier, we can grow a nice healthy rate of retained earnings of about 100 million a year, which is great. I think we've got a similar question. Tier 2, we are maxed out in relation to our tier 2 borrowing at the moment, but as we look to grow tier 1 capital, we'll be able to take incremental amounts of tier 2 capital that could unlock some further growth, but that is encapsulated in that 100 million a year that I talked about. In relation to other non-dilutive capital to accelerate growth, tier 2 is an option, as I said, but that's very small numbers. Enable guarantee, I think we're probably maxed out in relation to that. There are other conversations with the British Business Bank in relation to other ideas that they may have, but I would say that we're probably maxed out, and on all those other things, it will be retained earnings that support an organic growth plan without tier 1 capital. Question around dividends and maybe dividends generally. Look, I think it's a wrestle, and I think now we're at this point of generating sizable profits. We do have optionality as to what we do with those retained earnings, and it may well be that dividend is something that the board determines is the right course of action, whilst supporting perhaps a slower rate of growth. So rest assured, it is something that the board keeps under constant review, and will determine when it's the right time to do that. Thus far, it has not made sense, but it's right. I think Mark W, you asked the question. It's right for you to be raising that right now, given the extent of profitability that the firm is generating. Impact of base rate movements on profitability, and I think also the NIM direction of travel. Gavin, do you want to pick that one up?
Yeah. So I guess with respect to NIM, we saw in the first half it was 7.8%. As base rates have started to come down, we expect that to start to drop in the second half of the year. We're still going to be well above 7 by the year end, given the 7.8 we've got locked in already. I would expect next year it will reduce, but I think still high sixes. So I think it's going to be sort of 26, maybe 27 before it gets back close to that 6%. It's some way. I think it's some way down the track. The only caveat I would say is that the one uncertainty is with respect to deposits and the cost of deposits. When we get certainly into the second half of next year, there's quite a lot of banks who took out TFSME funding that becomes due for repayment. And we're not quite sure what that will do to the competitiveness of the deposit market, and therefore whether that might push up the cost of deposits, and we're keeping a close eye on that. In terms of profitability, I mean, we're clearly very profitable. That may bring down our NIM slightly, but it doesn't alter our aiming for our mid to high teens ROE in the medium term.
It's fair to say on that TFSME point that it would have to be extremely competitive for us to get anywhere near 6%. I mean,
I think so. Yes, I think so. Yeah. I think so. But it just might accelerate that reduction to an extent.
Yeah. But we talk about this 6%. That 6% was when base rates were really, really low. So it's got a long way to come back down before that fully unwinds to 6%. Again, a new dealer acquisition. How are you sourcing new dealers? Are you winning market share? And if so, who from? Look, I think yes, we are winning market share. We've seen in the the motorhome and caravan space, we do tend to transact with most of the high quality names. We win market share not on price, not on credit appetite, but on the quality of service that we offer relative to our competitors. Some of those competitors are the bigger banks. Black Horse, which is owned by Lloyds Bank, is a big competitor in the motorhome and caravan space, as an example. We have some of the French banks that are in some of the commercial assets as well. But it is service that we will win market share with existing dealers. We source new dealers largely from the manufacturer introductions. So when we bring on a new manufacturer, they give us access to their entire dealer network. It's on us to go and convert them. And a lot of those dealers will provide multi asset classes or multi manufacturer brands, and we look to build a relationship of offering great service through those dealer introductions. There's no obligation on us as a firm to because of the manufacturer relationship to work with every dealer. But we do look to try and work with as many that we can that fall within our credit appetite. So why have average stock days not yet fully normalised? I think as you look across sectors, you can probably see some which are normalised, some which aren't. I talked about motorhome and caravan earlier. Very strong market demand at the moment for the end product, and a lot of new loans being originated. So it's a story by sector. And then I think the last question here that we've got, which will be no surprise, is one that's front of our mind, And thank you very much to whoever wrote this. Your share price is not reflecting the current business. So you're doing an amazing job running the business, but the stock market is not reflecting this performance. Yeah, we see that. For our tangible net assets, per share to be almost 60p, and for the current share price to value the firm at 30. It isn't great, and we do spend an awful lot of time talking to our corporate broker. For those of you that have followed us for an extended period of time, you'll know we're working with Interim and Investec originally as a joint broker. I don't think having two materially helped us. We have been plagued by a number of our institutional shareholders having quite significant outflows in their funds. Some have had to sell their entire position, others have had to sell quite sizable blocks, and that has created an overhang. That being said, we a list of examples here that the questioners asked around are we considering share buybacks, dividends, potentially new research coverage, maybe a change in broker, or other M&A. Well, we've looked at the M&A route. We're not going to bring something into the bank that could cause organ rejection, stroke, some form of allergic reaction that would materially impact the firm's financial performance. Nobody would want us to do that. So we've moved on from that, having dated a few frogs, I would say, over the last few years. Research we're looking at financial PR. The board, as I said earlier, around dividends, are looking at dividends, share buybacks, whether those things would make sense in the context of us building that the journey to the mid to high teens ROE. But we get it, that shareholders do want to see a movement in the share price. We do. We're doing everything we can control as far as execution, delivery of the plan. And I hope for those of you that have been on this journey with us for an extended period of time, we'll see that what we say we do, we do, and that comes through in the results that we present to you right now. So I think that's the end of the questions. And Alex, can I hand back to you to?
That's great, Carl. Gavin, thank you very much indeed for addressing all those questions from investors today. And of course, the company can review all questions submitted today, and we'll publish those responses on the Investment Company platform. But before redirecting investors to provide you with their feedback, which is particularly important to the company, Carl, could I please ask you for a few closing comments?
Yes, thanks, Alex. Look, I think I hope it comes across we're passionate about the business. We've done what we say we're going to do. We're 4 years into this journey as a bank, and unlike an awful lot of early stage banks, where we've got to profitability early. We're using the retained earnings to support growth. It's not going after all sorts of development opportunities. We're not continuing to make losses, and you've seen in the results that we've posted for the first half, the strength of the business here. I'm absolutely delighted with the performance. Very proud of the DF Capital team, and really pleased with the culture that we're building here at DF Capital, and the support that we're seeing from our shareholders, notwithstanding the current share price. So I'm looking forward to the run up now to the end of the year, and catching up with you early in the new year with a further update on our performance.
Fantastic, Carl, Gavin. Thank you once again for updating investors today. Could I please ask investors not to close the session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Distribution Finance Capital Holdings PLC, we would like to thank you for attending today's presentation, and good afternoon to you all.